First-time home buyers have an extremely difficult road ahead in this market. So a very popular product right now for first-time home buyers would be down payment assistance loans. These come in many forms. They come at the state level, they'll be provided at a local level, and we also have products on a federal level as well. And the nice part about these products, they are directed for first-time home buyers, and they give assistance in the form of a down payment. And generally it's a percentage of the loan. So if you're buying your first house, most first-time home buyers have some form of down payment required, whether that's 3%, 5%, whatever it may be. These down payment assistance loans act as a second mortgage, and they give you up to 5% of the down payment in a non-repayable or a repayable grant. And so for a lot of people, the barrier to entry in home ownership is the amount of money that they need for down payment and closing costs. So this helps offset down payment and even potentially a portion of the closing cost, and can help first-time buyers realize their dream of home ownership. So the pros of the product are that you will be assisted with the money for your down payment and closing costs. What are the cons? Well, everything has some form of string attached. Nothing generally comes for free. Now, again, these products come in a local format, they come in a state format, they come in a federal format. So really, it depends on which one ultimately you go with. And then it depends on whether you're deciding to repay it or whether you're taking it as a grant. But a lot of them have a soft second or a lien attached to your house for a set period of time, whether that's 5 years, 7 years, 10 years. So I would view that as a potential con because we're in a high interest rate environment. If rates drop, some of these products don't allow for them to be subordinated, which means remain in second lien position, or they would have to be paid off as part of that refinance. So that money that you got for free, you end up repaying. The only other option is to remain at the high interest rate for the duration of that soft second requirement. So if the decision between buying and renting hinges on using one of these down payment assistance loans, the benefits of home ownership far outweigh those of renting. So let me give you a scenario here where a down payment loan would come into play. So you're a first-time home buyer, you go to your local bank or lender and inquire about a pre-approval. You go through the process. Lender gives you your pre-approval letter, your closing cost estimate, says you're good to go. You look through everything, the payment works for you. The cash to close is an amount of money that you just do not have and you cannot come up with. You don't have someone to gift it to you, you don't have the retirement saved yet. So you think that's the end of the road. The first thing you need to do is inquire about their down payment assistance loan. Not every lender, not every bank offers these products, okay? So it's important that if they don't, that you do not stop your home buying journey right there. You get on the line and find someone else that offers it. That down payment assistance loan could be the final hurdle on your journey to home ownership. So again, first-time buyers need the money to close. Down payment assistance loan is absolutely an option that you need to be looking at. One product that has become very popular over the past couple years is an investor loan that requires no income documentation or no ability to repay. So what does that look like? Investors have different type of financing that are available to them where we don't go into the traditional ability to repay. Generally speaking, when you're buying a house, we look at the ability to repay. So what we look at is your employer, how long you've been there, and we look at the earnings, and then we make a calculation against what the debts are that you're paying. Well, investors have alternative options. In the investment side, you have the ability to get approved for a mortgage using the collateral, right? So the house. This has come into play for a few different reasons. Number one, rent prices have contributed towards this product becoming more popular. So this loan program qualifies you off of the market rents versus what the debt on the property is. So rent prices over the past couple of years have exploded. And so for the same terms, an investor can opt to get qualified off of the rents on the property or providing all of their income documentation. It can be tedious, especially if you own a lot of real estate. And so investors over the past few years have decided to say, I'm not going to go and provide all of this documentation. Mortgage prices are higher. The debt on the property is higher. I'm going to qualify based off the collateral. And what's happening is that the rent explosion that we have seen has offset the increased interest rates, and the investor has been able to qualify easier over on this side and at a very similar price than what a conventional loan with all the hoop jumps would be. So pros of the product would be, number one, limited documentation. You're not, if you've changed employers, if you've moved from employment to a full-time investor, a lot of times that calculation on paper doesn't really look great. So this would be a solution to providing all of the documentation. If you're in the midst of changing from employment to a full-time investor, this would also work in that scenario. What are the cons of this product? Well, again, there's so many different options in this space, but these would be commercial deals. They can have a prepayment penalty. They don't require a prepayment penalty, but generally, if you pay or if you select a prepayment penalty, you can get more aggressive pricing. It's a tough market to project because, people think rates could come down later this year. It might not be till next year. How do I decide whether I should take a prepay, whether I shouldn't? We just run different scenarios. So a potential con for this product would be that there could be a prepayment penalty. Again, it's the investor's choice on whether or not they would select that. But essentially what happens is that if there's no prepay, the rate is up here. And then as you add a year or two or three, the rate comes down, down, down. So that can be viewed as a con. I more so look at that as something that you need to be aware of and consider when making your decision on that. So what does that situation look like? What are we looking for to see if this product is a good fit? Well, for starters, if you're new to the investment space, and you go to your local bank or lender to get pre-approved to buy an investment property, and they tell you no based off of your debt to income ratio, okay? A lot of people think that's the end of the road, right? If you're buying a property that is cash flowing, there are products like this out there, so you don't need to go through that process. So again, if a bank does not offer the product, if they don't lend on investment, if they tell you no, that's not the end of the road, I would think of one of these options. So what's a situation where you would consider the investor no-doc loan? Well, one of them would be an investor that is starting their real estate journey. Maybe they have 4 or 5 properties already. They've done all their business through a local bank or lender. They go to get another loan and they say that there's a debt to income ratio issue. We can't do it. That goes out the window. With this product, as long as the rents are good and we're cash flowing at a certain calculation, we don't necessarily care about any of that traditional financing. So if you or someone you know goes in and inquires about that and they're turned down over the debt to income ratio or affordability, whatever terminology they use, this would be a product that they want to use or look to. I like that. So another very popular product right now that people have started to consider again has been construction and renovation lending. We talked about in the past some of the problems with the current market. One of the biggest issues in today's real estate market is the lack of inventory. The lack of inventory has pushed prices up. Obviously, with prices being pushed up and paired with high interest rates, housing has become less and less affordable for Americans. And so a lot of Americans have opted to stay in their current residence, but they're outgrowing it. The property they bought 5, 6, 10 years ago doesn't meet their needs today of their growing family or their family that's getting older. And presented with the option of selling and having to spend $2,000 more a month to afford a house that's in the size range they need, a lot of people have decided to tap into their equity and to use renovation financing to expand their property to help meet the needs of their changing family. So that's become very popular. More people, being forced into that space because of the lack of inventory has really had this product explode. So it's something we've been doing for a long time, but over the past 2 years has become extremely popular. The other program that has become very popular is a new construction loan, so building from the ground up. The cost of resale has pushed so high now that people can build for a very similar cost as what it would cost to go into resale. And so people are really considering buying land, tearing down an existing property they have on land, and building from the ground up, building a property that meets their needs. So both products have become extremely popular over the past 2 years. Clients that would fit into this product, as we just mentioned, families that are growing out of the space that they're in and just can't afford to jump into what the step-up house would cost them. A lot of times they can expand their footprint of their house way more affordable than what it would cost to go up to a larger size home. Pros of the product. The product allows you to decide what is best for your family. You know, even if you're stepping up to a larger home, a lot of times you're not getting exactly what you want. You're compromising or you're settling on what the next house has available, especially in today's market. With so little inventory, if you have to move or you need a larger space, you don't have the luxury of waiting 2 or 3 years for the market to change or for more inventory of the perfect house to come. And then when it does, you're potentially bidding on that house with 3, 4, 5 plus other people. So this program gives you control. It allows you to build what you need, how you need it. So that's one of the pros of the program. What are the cons? You have to plan. You have to have everything done in advance of starting construction. So it can be tedious. I would say that that's a con for some people with busy schedules, young children running around, everything that we have to do. It's just one more thing. But if you can find the time to plan what you want to build, it's really an incredible product, whether you're building your own dream house, whether you're adding on to the existing home to help it meet your needs. It's an incredible product. So what is a scenario where this would come into play? Well, I have a 2,000 square foot house. I bought it when I first got married. We had 2 children. Our bedrooms are all full, and my wife is pregnant with our 3rd kid. Affording the next house is several $100,000 higher. We cannot afford to make that jump. So that would be a situation where you consider maybe $50,000, $60,000 addition, adding a bedroom, adding some more living space, as opposed to spending hundreds of thousands of dollars. That would be a situation where maybe it's not the home you're going to live in the rest of your life, but it certainly can be something that meets the need for a handful of years until the markets change and you can then make that step up. On the construction side, a scenario would be somebody that's in the market on their step up house, right? They own a house, they're looking for a bigger house, maybe they're looking for their retirement home, but today's real estate market just does not allow for them to find what they want. Like, they're very specific on what they want. The prices have shot up so much, and then on top of that, they still have to redo a majority of the house to make it what they want. That would be an opportunity for somebody to do a ground up construction and make all of the selections on their own, right? They can buy a perfect lot with a house on it that they tear down. They can buy raw land and have it developed. The options there are endless, but this would be a product for somebody that wants more say in what the house is going to be and is willing to be flexible and plan out a bit for that construction project to happen. One product that we do most often would be the agency financing. So FHA, Fannie Mae, Freddie Mac. These are referred to as conventional loans or FHA loans or VA loans. So we do quite a bit of these. One of the things that we do uniquely is that we don't put any overlays on top of the agency's guidelines. And this is important. What a lot of institutions do is they will offset risk by putting their own guidelines on top of what Fannie Mae or Freddie Mac or FHA have written in their guidelines. Oftentimes, we get a call when somebody is already under contract in the process and something goes wrong. Oftentimes, we're able to fix them without any crazy changes. So, although it's a standard product, the assumption that it's done the same everywhere is just not true. So, if you are in a situation where you are either at the pre-approval level or beyond, and you run into issues for, say, an FHA loan, and someone turns you down, that is not the end of the road. I encourage you to get back on the horse and make another phone call. Same thing with conventional. If you are at the pre-approval level and you cannot get pre-approved for X, Y, or Z reason, every lender is not the same in terms of how they're lending. Just because it's a conventional loan doesn't mean we're all doing the same thing. Some lenders put additional guidelines in place that disqualify you from the program. Nothing personal, it's just their risk tolerance that they're willing to take. But you might not meet that threshold. So the worst thing we can do as a potential homeowner or home buyer is to quit when we get told no. Obviously, I'm a resource, but there's many others that will engage with you and try to find a solution that works. A lot of what we do in this space isn't necessarily black or white. There's a lot of gray area in the interpretation of what we do. The point is, if you've been told no, if you're trying to accomplish one of your dreams and you're running into some issues, continue to call people, continue to have conversations, try to get it specific as you can, ask why, take notes, find detail on why. If I'm speaking with somebody and I cannot approve them, what I want to do is I want to give them as much information as possible, almost teach them about what we're looking at on the lending side and why they don't fit the guideline. I also, whenever possible, want to give them an offer of something that's as close as I can get to what they want to achieve. So, first-time home buyer wants to buy a house, but I just cannot make the debt-to-income ratio work for affordability. I'm never just going to say, no, I can't do it, right? I want to inform them and give them as much information as possible so that if they can't do anything immediately, that they can at least start working on a solution. I also, at that same time, I want to give them a counter offer of what I think would work. With a first-time home buyer, one of the easiest counter offers is, are mom or dad or family member willing to assist or co-sign with you on the loan? You'd be shocked at the amount of times that has been offered to people. It's absolutely an option for them, and they've talked to 2 or 3 lenders who had never even offered that up to them. So again, if you're on the lending side, let's not assume anything. Let's always give a counter. Let's give them the options of adding somebody. Gift can come into play, whatever it may be, and try to provide them with a solution. Ultimately, if they don't, then we can't do anything at that time. But far too often, we stop short of what could be a potential resolution and could help somebody achieve their dream of home ownership.